Hi everyone, Piers here, the Chief Investment Officer at Viridian. Well, it's been a little while since we've last caught up, and I thought we'd share with you some of the thoughts that we've been having from an investment committee perspective at Carrington's, Jason, Nella, Brian and myself, and just how we're seeing financial market performance, particularly equity markets, and how we're thinking about that from a positioning perspective as it relates to individual portfolios and the conversations that the guys are having with you. One of the first things to note straight off the bat has been, a very pleasing rebound in equity markets, whether it be domestic equity markets or global equity markets. And, since the March lows, we've seen a very strong recovery, roughly around about 16% in the local market. Clearly hasn't clawed back all that negativity that we saw through February and March, but it does show how difficult it is to time investment markets. It hit that low point. Many investors were thinking this is going to be the end of the world, and their markets, have had a very short and, reasonably sustained rally, and that's also occurred on a global basis. So we thought we'd just share with you a couple of charts today that really just underpin some of our thinking in regards to positioning, particularly back into equity markets, and where we see the valuations in the short to medium term. And the first chart here is just showing the domestic Australian equity market, as well as what we know as the price to earnings ratio. So think of this as, how much do I have to pay for a dollar worth of corporate earnings? And you can see there the performance of the equity market after, as I said, hitting those lows back in March has rallied quite significantly. But equally, that PE ratio has also moved significantly higher, up from roughly around about sort of 14.5 times to 19 and above. So effectively, you're paying an extra $5 for a dollar worth of earnings over the last 6 to 8 week period. So in effect, the earnings side of the corporate listed corporates hasn't yet matched what we're paying for in terms of the pricing side. So when we look at that chart, one, it's a very positive chart, but equally, we would say that the market might be getting a little expensive relative to history, and certainly relative to the earnings outlook that we're seeing in the short to medium term. Those two dotted lines represent, a plus or minus one standard deviation move, so reflecting the risk of the market. And by and large, when you start to move outside that band, we do feel that's sort of a signal to us that markets can be getting a little expensive, and depending on how far you move, obviously, outrightly expensive. So as we sit here today, and you can see obviously the deviation from that band, that certainly the domestic market is looking, as I said, certainly a little bit more on the expensive side relative to the earnings outlook, which, as we know, is going to remain constrained in the near term. However, financial markets are forward-looking, and one of the reasons why the equity market has rallied is that the stimulus packages that we're seeing both domestically and globally, both from governments and central banks, is clearly providing a very good and base platform for financial markets to continue to move higher through the second half of this year into 2021. And this is one of the reasons why, as I said, we've seen that sharp rally. The efforts and the money that has been, as I said, put into economies, both domestic and global, has certainly, as I said, provided that floor as we move into the second half of this year, as economies start to reopen and as the growth outlook clearly improves. Australia has been clearly a global leader in the context of managing COVID-19, and we're seeing, clearly that both in the statistics and, as I said, the speed by which we are reopening our local economy at a greater speed than what we're seeing in offshore markets. The second chart really is just a mirror of the domestic market. Just looking at global equities, it pretty much paints exactly the same picture. We've had a sharp rebound in global equities, and equally, as I said, the PE ratio, so the valuation that we're seeing on the market, has also increased. So it's, as I said, becoming more stretched in regards to where we see the attractiveness of the market. So when we translate those two views back into portfolio positioning, what's it mean? Should we avoid moving into equities at this point in time? Should we wait for another pullback? Again, we reiterate that strategy is the most important element when thinking about portfolios and building long-term wealth. And when you're thinking about the equity markets, no one knows when equity markets are really going to, as I said, have significant rallies or significant sell downs. And we've seen that, as I said, through the back end of March. No one would have predicted we'd be in a situation where we are today. So in the context of that, when thinking about strategy, we certainly have the view that continuing to invest in the market is appropriate. But what we'll be doing at this point in time, and the way the guys be having conversations with you, is about, well, should we be potentially just averaging into the market over a longer period? Now, that might be 1 month, 3 months, 6 months, depending upon your requirements. But it's ensuring that you're always just trying to capture and build to that strategy, which ultimately will then lead to the build of, the long-term wealth creation that you're looking for. Markets will go through periods where they underperform over the next little while, and we think we're probably heading into some level of consolidation. And that's always a good opportunity to take the advantage, to be able to chip back into the market to take advantage of those lower prices, because when the market rallies, you're capturing more for the dollar that you're investing. Ultimately, our view is that the PE ratio will start to move lower as corporates start to grow their businesses again, as economies start to reopen, and the earnings side of it continues to grow. And we believe, certainly with the support that is being delivered by both federal governments as well as central banks globally, that's going to provide a very positive backdrop for financial markets as we head into the back end of the year, and certainly into 2021 and beyond. So in that context, we think that the longer term outlook for growth assets continues to look positive, despite probably many of the challenges that we're going to continue to see over the next 3 to 6 months. As always, the team would love to hear from you. We'll be continuing to provide these videos and just try and give you a bit of a snippet as to how we're positioning portfolios and some of our broader thoughts on markets. We look forward to catching up again then. Thanks, and bye for now.